So today's cardinal lesson, we're talking about an investment strategy in retirement, or an investment strategy that's tailored to people that are retired. And so when you're in retirement, when you make the transition from working to retirement, instead of adding money to your account every month, you're going to be taking money out of your retirement account every month for the rest of your life. And so your investment perspective goes through a radical change. And I'm going to do the why today. I'm going to share why we're doing this video instead of Tom, is that as we're doing plan presentations, financial plan presentations to incoming clients, I'm brought in at the end. These guys have done all the work, Tom and his team, and they're presenting. And just some clients, we present them moving their money under our management. Some clients we don't. They don't necessarily want that. They're going to keep it where it is. But in any case, we're showing to a lot of these people, if they were to take their money from where it is and move it to here to us, we're going to be managing it and what that looks like. And then we're going to get into the investment philosophy. And I've just was so personally impressed by this meeting after meeting after meeting, and it's tailored to the specific client. Impressed as well with the simplicity of the language, that I just decided we're going to do a video about it. So that's why we're doing this video today. And I want to push it to Tom for some further commentary on the why, and I also want you to share the show notes.
Yeah, I mean, I think one thing that we don't do a lot on our YouTube channel is talk about us investing, helping people with their investments. It is certainly a piece of our business. It's not a requirement for us to do a plan for you, so you don't feel like if you come to do us a plan, you're going to get pitched this. I mean, we might if it makes sense, but it's certainly not a requirement. But we want to give you a little bit of context if that's something you're interested in, how we approach it, right? What is our philosophy? Make sure it's in line with sort of how you view the investments, just see if it's a good fit. So as we go through the show, hopefully that comes across and then you get a little bit better idea of how we approach the investment of money when we're actually helping with the management piece of it. So let me bring up the show notes. You can find these below the link on our video. They're also on our website at cardinalguide.com. We have the board. We'll get into that in a second. We pulled some sort of sample pages from a plan we did. We removed all identifiable information. So this isn't, you wouldn't be able to tell whose information we're looking at here, but we'll get into the example there. And then a big part of the show notes is really sort of this investment comparison. Again, we'll come back to this here, but if you want to get more information, get more into the details, if you like these type of numbers, it's there. It's in the show notes. It backs up everything on the board. And so take a look at it. If you have questions, you can call us up. But let me turn it back to Hans here. And we're going to go over sort of the left side of the board, which is sort of the example and sort of big picture what we're doing with the clients. And then I'll go over the right side of the board that gets into the specifics of how we approach the investment philosophy. So Hans, why don't you
Yeah, Tom, if you would bring up the graph that shows this in the show notes. So on every one of these plans, we show how the client is currently invested. We always ask people, like, how did you get here? Why are you here? Why do you have 64% in equity and 36% in fixed income, which a lot of them didn't even know that's where they were until we analyzed all their stuff. That's part of the financial planning. And then we put together this graph, and then we go through and we do the financial plan like if they never met us. And so we make all the predictions and show them how successful they would be if they changed nothing. And then we make a proposal, and that's over on the other side where it just shows, in this particular client, we made a recommendation that they would move to 70% equity and 30% fixed income. And that's putting a little more risk into their portfolio. And we were able to do that because they also purchased an income annuity that is going to start right when minimum distributions start. This fella is like 68 now in this example, and he's going to purchase this income annuity, and that's all considered fixed income. So they can take a little bit more risk, and they really need to take a little more risk because of their young age and the longevity. Now, in the proposed investment strategy of the 70% equity, we're recommending 80% U.S. equity and 20% international. Okay, And that's pretty typical for us. And then of the 30% of fixed income, we're not going to be focusing on this show how we invest that. But in some cases, people put that or a portion of that into annuities that just accumulate, but they have a guaranteed fixed interest. And those are going to compare favorably with bonds. So back to the topic of the show, we're going to really focus on this 70% that's in equity, 80% US, 20% in international. Um, and so I want to push it to Tom, and Tom is going to talk about factors and factor tilting.
Yeah, so I think once we have sort of decided on the overall asset allocation, which that's how much equity to fixed income that you're going to hold, whether it's 60/40, 70/30, 80/20, right? Again, it's very dependent upon the particular client, their risk tolerance, how much risk they're comfortable taking or willing to take or able to take, right? I mean, there's a lot of factors that go into here. So this certainly isn't a blanket recommendation for everybody on the show, but let's just assume we arrived at that same 70 equity, 70% in equity, 30% in fixed income. Now we get into how do we approach the investments of that? And there's an idea in investing called factor investing. Factors are just they're themes of equities that share a common characteristic. So it's things that are sort of grouped together. It's an idea that came out of sort of academia and then has made its way into sort of in practice investment management. A common one that people probably have heard about, but they don't necessarily know that it's called factors would be like growth versus value, right? Those would be different factors of investing. There's many other ones there, so I don't want to get today isn't necessarily a lesson on that, but it's important to understand sort of that idea of these similar characteristics with common themes, because that's how we approach sort of the overall investments. Once you're sort of okay with that, what we then do is we tilt the portfolios to capture more of that factor. So tilting the portfolio just means sort of taking it and getting a little bit more of that factor than the overall market. So our goal is not to have it drastically different than what the market's doing, right? We don't want to go and just only buy value companies or only buy growth companies or only buy quality companies, right? We still want broadly diversified portfolio that is just capturing more of those type of factor companies than just the broad market is. And so once we get into sort of that sort of topic, the three sort of factors that we're focused on, one is quality, right? So quality companies are going to be defined as companies that are highly profitable with very stable balance sheets, right? They're not over leveraged. They don't have a lot of debt on the books. And so we try to capture more of those type of companies than just the broad market would. The next one is value. So again, we're not exclusively investing in value companies. We still want access to the growth companies. We want a little bit more of those value companies compared to growth companies. And then size. So the one we sort of target is sort of these mid cap companies. So not exclusively mid cap, but we have a little bit more mid cap than what you might expect as a broad market. And again, that has boded well historically. And so in the show notes, let me bring back up the show notes here. You can actually see sort of this summary of these two lines here. And again, the appendix has all the supporting documents here. This purple line is really this sort of factor model that we use. This is that same 70/30 model here. The orange line is sort of an appropriate benchmark. So the benchmark we're using is one that has the same, it's essentially total US market, total international market, and total bond market. Those are the three components. And then it's mixed at the same proportion, right? Same 80% US equity, same 20% international, really trying to identify over time where you've seen that quality or that factor investing sort of doing well. You'll notice these track pretty similarly, right? They're not big drastic swings, not big drastic differences, but over time, you've seen it sort of outperform there. That doesn't mean it's going to do that moving forward, right? That's always that same idea in investing. It's just because it's done in the past doesn't mean it will do it in the future. But this gives you some sense there. Another point I'll make is when we're building the portfolio, sort of the building blocks we're using, what is sort of the investment world that we're targeting mostly? Primarily, we're using low cost ETF funds, exchange traded funds. So again, that provides that broad diversification. It provides sort of low cost ways to get access to this. So it's not a lot of active trading, right? We're not buying and selling a bunch of stuff over time. We really set the model portfolio, we rebalance quarterly and use these low cost ETF funds to get to the target allocation that we're going for. So I could go all day about a lot of this stuff. I don't think that's what you really want to hear me do. If you have questions and want to talk more about it, give us a call. We're here to talk about it. But again, I think this gives you sort of a big picture view how we approach our investment philosophy. So let me turn it back to Hans and see what points he has left.
I mean, it's important to understand our custodians that we use are either Charles Schwab or Fidelity. Most of it is at Schwab. And we're the drivers of picking the strategy along with you and then trading in ETFs to get as close to the model as we possibly can. And this stuff can be kind of confusing, and what we're known for is simplification, talking in general. We just wanted to give you a little look into the thinking of our strategy and how we manage people's investments. And what I want you to get clear on is that most of our clients that are new to us are in their 60s, and then they're with us, and then they're aging from there. And it shows, a lot of people in their mid 60s are going to start off with an allocation like this. They're going to gravitate towards 60-40, and even in their 80s get to 50-50. Depends on the client. We're going to meet with people quarterly. So if we are managing your money, we're going to have a short meeting every quarter to go over the results, go over what happened, go over any adjustments that we're going to do, and we keep this going. This isn't something we force on people. We're financial planners at heart. So if people come to us and they want us to look at their whole thing, write a financial plan, tell them what we think in all 7 of these areas, put it in writing, and then they want to take their money and just leave it where it is and begin doing some things differently, or they want to leave it with the person that's doing it, that's fine with us. Is what we're showing you here today is if you put it under our management, we're going to put it to Charles Schwab, and we're going to have this type of thinking is going to be behind the strategy. Of course, you're going to be part of that all the way along. So I want to go over the 7 subjects and what we talked about today. We haven't really talked about Social Security. We haven't talked about Medicare. We haven't talked about long-term care. We have talked about IRA because a lot of this money that we're managing is in an IRA and 401k. We've talked about income from the produce, that all of these investments need to produce an income for that. This is usually the most important subject amongst people. And a lot of times minimizing risk or trying to lower risk is a big thing. I mean, obviously people want us to take risks and earn them a big return, or they're going to earn a big return with the money under our management. But, we try to get them focused on reducing that risk because this money needs to last a whole long time. So the income is a big piece of this. We haven't talked much about estate planning or taxes, because none of this subject is about taxes, but taxes are certainly a part of the overall financial plan. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.